Moneyweb now. On the money.
This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. Chatting with Dishon Chetty, equity analyst at Ford Asset Management. Dishon, appreciate the time today. Consumer confidence, a recent note you put out, negative for 7 years. I hadn't realized it had been that long. I know it's tough being a South African consumer, but we're talking like back sort of pre-pandemic that we've seen the squeeze on consumers. We haven't stopped spending, but we've certainly had to get smarter about how we spend our money.
Yeah, you definitely do. I think it's been a very resilient segment because, food is essential. But what's amazing about food is that it only had 4 years that volumes were negative, and food retail sales have never been negative. But you are going into, as they do pass on food inflation, the retailers, but we are going into a much weaker consumer going forward. And you can see the signs of that pressure even in the high end. And you can see it with the low end also.
That's a good point because, it's around, we've been shopping smarter. We're using promotions. I imagine a lot of brands switching at the same time as well to sort of try and keep things on the table, but, less money to go around.
Yeah, I think the brands, it's interesting to see how the consumer behaves because the brand perception is what drives sales and the instant promotions, and the consumer has to be a bit more savvy. So I think there's going to be more a rotation into different retail brands, and those that have that cheaper perception, those that are already cheaper or using their scale. So it's going to make it a little bit harder for some of the other retailers, especially with a weaker consumer and protecting GP margins, to remain competitive.
Is it as simple then almost to say the winners here is broadly ShopRite, narrowly Checkers, and especially 60/60?
Yeah, I also think Boxer will do very well. So I think they are leading the front in terms of their model, in terms of differentiation and low SKUs to get deeper promotions. And they already have a lower price point than their peers. So I think they're also included in that mix of down trading from consumers.
Let's delve into that Boxer because, as you said, they do it different to perhaps the others. It's very much that discount model. There's less product range, but it's high volume, sort of low price. In a sense, classic discount retail.
Yeah, I think the key here is that in the categories that they do play in, they have very high market share. And because they're growing volumes at such a strong pace, the suppliers want that volume. And as they grow into more space, that volume grows even further. So they can actually get some really good promotional pricing if they can deliver on those volumes. And then on top of that, they've got a very low cost model, very simple DC. And then that just creates more sustainability in terms of your margins.
And that then, that comes back to the ShopRite Checkers, where they've got the DCs by the dozen. They've got the suppliers, they do the volume. They've also got data on the customers as well. They're never out of stock. The formats work. They're the other side of the equation, but doing it as well in many ways.
Yeah, I think they will. I think they'll continue to do well. I think the most important thing is being able to execute and to use those promotions and use the data from the loyalty card and then the strong private label. Retail, you have to do a lot of things well to be competitive.
That's a great point. It's not just any one box, it's many of them. But where does this leave Pick n Pay and Spar? Spar, the convenience, Pick n Pay used to be about price. The older listeners will remember the sort of Raymond Ackerman days of Pick n Pay. They seem to have kind of got a little bit left on the wayside, particularly Spar in terms of convenience, when I can now sort of get it delivered via a 60/60 scooter.
Yeah, I think Spar, there is a lot of internal issues that they had also. So that also compounds it. And then with the franchise model, sometimes it can be harder to execute because ShopRite management team can make a decision and it's executed at all the stores very quickly. So there is a bit of a leakage there. But some of the franchisees in Spars are very good and obviously some are not. And then the convenience side on 60/60 did definitely hurt that model.
What about Woolies? They obviously a bit of a top end. They've also got the fashion, the beauty side, been struggling a bit. Where does Woolies sit in all of this?
Woolworths has grown like-for-like sales quite strongly. It has slowed down like everyone else. But I think they do have a differentiated model in terms of their fresh offering, ready-to-eat, high-quality products. But I think they can definitely improve their online offering.
Yeah, I was going to say, their online, I think, is perhaps in their delivery is their weak experience. A question around food is private label. I'm surprised perhaps, and maybe I'm just not a good shopper, I always expect to see more private label in our stores. It seems an obvious way to try and help the consumer on price. Where do we sit as a private label as for consumers?
It's actually amazing. I think private label penetrations country is starting from a high base. So we are sitting at, I think, around 23-25%
Oh,
of
wow.
sales
Okay.
is already private label. And I saw some stats that the global average is 15. But what's interesting is that you look at ShopRite, which is one of the best players in private label. They only grew sales in private label 6.6% in 2025, which is slower than their group sales. So I think one factor is that you do have a lot of good food producers that are also lowering their brand premiums. They're also lowering their cost of manufacturing, value engineering, launching cheaper variants. And then you also have, private label needs capacity, and there isn't that much food manufacturing capacity out there. That also restricts some of the private label growth.
I take that. And also, as I'm saying private label, I'm sort of thinking back to the anonymous milk carton. But for example, with Checkers, the Forage and Feast fits in there, as I would imagine as well, which is kind of, I don't know, middle to upper.
Yeah, I would think that the secret that they've done is similar to what Clicks has done with private label, is that you buy a brand of private label that you might not even realize is private label. Or if you know it's private label, you trust it more because the branding around it. So Simple Truth and Forage and Feast have created very good private label brands.
Yeah, I do suspect. I mean, I know about them as private label because I'm in industry, but I'm not sure everyone does. Moving away to a bit and thinking about clothing for a last question. I mean, this is obviously a tough area. It is more discretionary. It's got brutal Chinese competition. I mean, is it as simple to say that the sort of lower cost and sort of cash-based, which is maybe Mr. Price, are the better positioned here?
No, I mean, I think in a weaker consumer environment that we're going into, I think discretionary items will be impacted. And we can look at, the like-for-like sales of the retailers have been quite tough, like around 0 to flattish. We saw with Pick and Pay today, it was down 1. So I think people are, if you're under pressure, then you kind of reduce your non-discretionary spend, and the competition is tough.
Yeah, and I can probably wear that shirt for, I don't know, another season perhaps before replacing. It's not food I need to eat. We leave it there. Shoshana Chetty, equity analyst for Asset Management. Appreciate the time. This podcast is brought to you by StandLib Asset Management. Invest in more certainty to navigate volatile market conditions.